George Schultze, let's talk about some of your favorite longs and shorts. And we'll start off with Arch Coal, which emerged from bankruptcy earlier this month. Now, the current environment, and if Hillary wins, perhaps the future political environment is negative for coal. So why do you want to own Arch under these circumstances?
Well, remember, there are two types of coal. There's metallurgical coal, which is used to make steel, and there is steam coal, which is used to make electricity. There's been a big political push against steel coal producers because of environmental issues that come from burning coal in the environment. And natural gas is a much cleaner fuel. However, there's no other way to make steel other than to use met coal. And Arch is the largest met coal producer in the United States. It came through bankruptcy and eliminated about $5 billion in debt. The company is completely delevered now. And this year to date, met coal prices are up almost 300% so far.
All right, you also like Energy XXI bonds. This oil and gas driller went bankrupt, I think it was earlier this year. So why do you like the bonds? Because there's still a lot of pressure on oil and gas prices out there.
That's right. And there are a lot of over-levered oil and gas producers that need to restructure. So far this year, over 100 have restructured through bankruptcy. Energy XXI is nearly through bankruptcy. It's nearly through its bankruptcy proceedings. And the second lien bondholders right now have the edge. And it looks like they'll get the lion's share of the equity that's issued when the company emerges from bankruptcy. In that case, the company will be completely deleveraged, and the outlook is much better for Energy XXI going forward.
All right, next, this is an interesting one. Caesars Acquisition Corp. Now, Caesars went bankrupt. This is a cantankerous, contemptuous, this is a battle royale, this bankruptcy. The stock, this is CACQ, is up over 80% this year, but you want to short this stock. So tell me why you don't like it.
That's right. One of the most litigious bankruptcies I've ever seen in 20 years of doing bankruptcy and distressed investing. Now, CACQ is the operating company that was the recipient of the asset transfers out of the main holding corp. The way the plan is structured now, and there's a global settlement, which means it's very likely to be concluded this way, is that those equity holders will get about 24% of the newly created equity when Caesars emerges from bankruptcy, probably in January or February of 2017. And that's all good. The company is eliminating about $15 billion in debt, but it's still too expensive. And for those equity holders, you're creating the new enterprise equity valuation at almost a $15 billion value. And there are just much cheaper ways to create that same equity, either through the bonds, and I think at that value it's about $5 or $6 billion, or through the CZR equity with a similar equity valuation.
And then finally, you are a fan. This one you're long. Fiat Chrysler, which is down, I think, over 30% this year, even worse than GM, certainly worse than Ford. So why do you like it?
So this is the cheapest auto stock out there now. The company has about 110 billion in euro revenues each year. It trades at about 5.75 euros per share. It's just incredibly cheap. Nobody wants to own autos. This one is doing well. It spun off the Ferrari business earlier this year. Then it spun off the RCS Media business. We think there's a possibility that they might spin off Maserati as well. And it's just incredibly cheap. You can own this world-class automaker without much debt at all at about 1.5 times EBITDA.
All right, well, thanks a lot for coming on and giving us your longs and your shorts.
Happy to be here. Thanks.
And thank you for watching The Street.